Will the Social Security Fairness Act bankrupt the Social Security Administration Trust Fund? Well, that's one of the questions that we're going to answer today in this episode of Decoding Retirement. Hi, I'm your host, Bob Powell, and my guest today is Professor Olivia Mitchell. She's a professor at the Wharton School of the University of Pennsylvania. Professor Mitchell, welcome.
Thank you for having me. It's my pleasure.
It's my pleasure. For those of our listeners who are unfamiliar with you, you are, dare I say, the leading academic voice on the subject of retirement. So it's a pleasure to have you here. And it will be a pleasure to have you sort of at least tackle this first question about the Social Security Fairness Act, which will help many, I think, on the upwards of 4 million public employees receive their full Social Security benefit, but people are wondering what effect it will have on the trust fund.
Well, unfortunately, it's not going to be a good result when the Social Security Fairness Act is rolled out. I think there's been a little bit of a delay so far, but it's in progress. The reality is the U.S. Social Security system already is facing insolvency by 2023. After that, full benefits cannot be paid unless the system is reformed. And unfortunately, this act that was passed by the Biden administration is going to hasten the system's insolvency date by about half a year. Now, that's different than saying the system is insolvent. Let me correct that. That's different than saying the system is bankrupt. That is, it's still going to have enough revenue coming in to be able to pay about 75% of scheduled benefits. However, there will have to be benefit cuts around the realm of 25% for all current and future retirees, since there simply isn't enough revenue coming in to keep the benefits that have been scheduled.
Yeah.
So alternatively, payroll taxes will have to be increased by about 40% immediately and forever. And so the reality is that we're facing a big problem. The Social Security Fairness Act, which honestly raised benefits for a few public sector workers and their spouses, really didn't help the problem. It actually made it worse.
Yeah. So when you think about the policy reforms, increasing taxes is one lever. Reducing benefits is another, or a mixture of those and other things. Do you have your favorite reforms that would help us alleviate the trust fund depletion?
The reality is there's no single magic bullet, unfortunately. I think if it had been easy, it could have already happened. I actually served on President Bush the younger's commission to strengthen Social Security back in 20 years ago. So that would have been 2001. And at that point, we still had a bit of a runway to do some reforms and avoid the big problems that we now confront. But right now, it's going to be very, very difficult and delicate. I mean, there are proposals to raise the full retirement age. That's the age where you get your full unreduced benefit from, say, 67, which is what it is now, up to age 70. And I do think that people should continue to work longer if they're able to, and that would provide some incentive to do that. The downside of raising the full retirement age is that people who claim as early as they're allowed to at 62, that's the early retirement age, would have their benefits decreased. And that is going to be very troublesome for people that are unable to be able to delay claiming.
Yeah.
Another proposal has been to boost the number of years. Right now, only 35 years of your highest earnings are included in that benefit calculation. The proposal is to raise it to 40 years. And if you haven't worked for 40 years and earned pay, then that would increase the number of zeros in the formula, and obviously your benefits would be reduced. So those are some of the proposals that have been made. Others have recommended taxing all of Social Security benefits subject once you receive a certain amount of adjusted gross income. Right now, only 85% of your Social Security benefits are subject to income tax. Each one of those changes that I've just enumerated solves a little bit of the problem, but it certainly doesn't correct the entire thing.
Mm. I want to turn my attention away from policy for a second to things that might affect people. You've done volumes and volumes of research. I had a tough time figuring out what to ask you about, given all the research that you've done. But there was a piece that was published, I believe, in the National Bureau of Economic Research recently, where you looked at what people regret when they retire. And I'm curious about what you found and what people can do to avoid this regret.
Well, we've done a fair amount of work trying to study what older people do regret. And we were surveying people over the age of 50. And we asked them questions like, we didn't use the word regret because that would have been too leading, but we said things like, looking back, if you had to do it over again, would you have liked to have saved more, about the same, or less? And a majority of the respondents said they wish they had saved more. Only 2% said they wish they had saved less. So definitely regret for not having saved more along the way was very salient. Another thing we found is people regretted not working longer and not deferring claiming their Social Security later. Both of those things would increase the amount of money they would get when they eventually did retire. And the final thing that I found very interesting was that older people regretted not having purchased lifetime income. Lifetime income streams would come from something like an annuity, where you purchase from an insurance company a lifetime income payout that will make it much easier for you to manage your expenses. Even in later life, many people become demented. Many people are financially not as literate as they were when they were younger. And having that steady income stream is and can be a real boon. People regretted not having done that as well.
Mm. And if memory serves, I think the regret differences between the races was notable. The difference between black and white regret. Is that fair to say?
And also for women, women tended to be more likely to regret depending on others, frequently their children, or wishing they could depend on others. So a related theme that we explored was that if we explain to people how long they might live, in other words, their risk of living a very long time, they were much more likely to regret not saving and not buying lifelong income payments. The reality is that when you ask people about how long do you think you're going to live, they're pretty on target because that's an average. The life expectancy numbers are relatively well known. But if you ask people, what's the chance that you might live to be 75, 85, and 90 years old? People definitely underestimate that. And therefore, they don't save enough. They don't buy lifetime income, which continues as long as they are going to live. They also tend to underbuy long-term care insurance because they just don't understand how long they might live and the potential frailties they might face in later life.
So you teach a course at Penn called, I think, Consumer Financial Decision Making, and one of the goals of the course is to help people take charge of their financial futures. What can people do to do that?
Well, this is a course that's offered through the Wharton School to all undergraduates with no prerequisites. No, you don't have to know economics, statistics, or finance. So we spend the first couple of weeks teaching them that. And then our approach, these are kids, young people who are, say, 18 to 22. These are people who early in life, may have confronted problems with student loans or credit cards. So we take a life cycle approach. So early in life, we focus on those decisions that young people are making right away. And then we more or less go through the life cycle. So at some point, maybe the student or the former student would think about trying to buy a car, buy versus lease the car. What do you have to do to buy a house? How do you establish a credit record? And then when I come in, because we split the course, two of us, when I come in, I start talking about saving for retirement, investments, obviously annuities, Social Security claiming, and last but not least, estate planning and wills and trusts and things like that. So I've had the kids go home during Thanksgiving and they come back right afterwards and say, "Oh, I talked to my parents and my grandparents and they find this so useful. This is the most useful course I've ever taken." So I feel good about that.
That's great. So what advice do you give these folks in terms of taking charge of their financial futures? Is it to just be mindful of these topics and to incorporate these actions into their life?
Well, you have to start simply. You have to understand and you have to teach people it early in life about the dangers of compound interest. If you don't pay your credit cards on time, then you're going to end up building a bigger and bigger overhang of debt, and that's going to be very problematic to you in later life. We also talked to them about the benefits of diversification. Don't put all your eggs in one basket. It's hard to explain to an employee at Apple that may have invested his or her entire 401k plan in Apple stock that actually that's not a very good idea ex ante. It's hard to convince them after the fact that they should diversify. But then you can point to examples where companies went bankrupt, like Enron, and people lost not only their jobs, but their entire retirement nest egg. So, and then, of course, inflation has been a topic much in the news of late. Back 10, 15 years ago, people didn't really ever think much about inflation. And now it's more salient, especially with food prices and housing prices and everything going up so rapidly. So all in all, those are the places that we start and we build from there.
Yeah. Olivia, we're going to take a quick break, and when we come back, we've got a whole bunch of things to cover: 529 plans, defined contribution plans. So don't go away. We'll be right back. Welcome back to Decoding Retirement. I'm speaking with Professor Olivia Mitchell from the Wharton School of the University of Pennsylvania. Olivia, before we broke, I promised that we would talk about a study that you conducted regarding 529 plans, and I'm not going to spoil the results, so I'll leave it to you to walk us through it.
Fantastic. Well, many of us have contributed to our children's or grandchildren's 529 college saving plans. And then those of us that haven't yet, be on the alert because they're a very efficient and useful way to help save for your children, your heirs, your offspring's college. And as we know, many different states offer these 529 plans. And the plans are not the same across states. So in this study, which we just published, we were trying to examine whether individuals who contribute to 529 plans are doing the right thing. Are they selecting the right plans? And how bad a job do they do if they don't select them? So what we estimated was essentially 2/3 of the open accounts that people had opened between 2010 and 2020 were located suboptimally. In other words, the plans were inefficient, they were expensive, and this would generate in 1 year a loss of about $16 billion for the savers. So then the second question is, why didn't people do a better job choosing the state 529 plans? In other words, just because you live in state X doesn't mean you have to put the money into state X's 529 plan. You should be looking around to see which other states offer more efficient plans. And so what we found is that a lot of people did not take into account the costs of the local versus non-local 529 plans. And they also didn't take into account potential tax benefits that they would be able to get. The follow-up was we tried to investigate why didn't households do a better job, and we found two reasons. First of all, the plan disclosure documents are incredibly complex, non-standardized, and hard to read. And so on average, people faced with a 100-page single-spaced document may not spend the time it takes to parse through it. And the other issue is that we know people, on average, Americans and others as well, are not very financially literate. And so lack of financial literacy can also make it more difficult to understand and compare these 529 plans. So taking it all together, our concern and our recommendation is that it would be very important for people either to do the research themselves or to ask their financial advisors, if they have them, to help choose which is a better plan for them and their offspring. And in our paper, we noted that some of the best plans were due to a variety of factors, tax status and low costs, were California plans. Some plans, like the Florida plan, there's no state tax. So there our results are that it's not a one size fits all.
I know you and your colleague, Anna Marie Lusardi, spend a lot of time looking at financial literacy, and there's a trend that troubles me, and I think it troubles you as well, that more and more older adults are retiring with debt, mortgage debt, student loan debt, et cetera. I'm wondering if you could talk a little bit about the state of affairs there and what advice you might have for folks who are retiring with debt.
Well, I remember about 10 years ago, my husband wanted to retire, and I said, all right, let's talk about the financial pros and cons. And he said, well, I'm from Ohio. And in Ohio, people repay their mortgage and then they're allowed to retire. And I said, okay, that's what we'll do. We could manage that. And he repaid the mortgage and he retired the next day. But that attitude is not true of retirees today, by and large. 20 years ago, people retired and they did draw down their mortgage, pay off their credit cards, entered retirement without so much debt. 20 years into moving forward, more and more retirees are moving in having not only not retired their mortgage, sometimes they take out a bigger mortgage when they want to move to a sunnier clime or a different state or what have you. Also, credit card debt has become increasingly important. And strangely, perhaps, about 6% of retirees are now having their Social Security checks garnished because they haven't repaid their student loans, either for themselves or for their children. So debt is increasingly troubling the older population. Moreover, with the inflation rate being so high, that is translated into higher interest rates for mortgage debt for many of us, for credit card debt, for student loan debt. And so it becomes a very big challenge for people to meet that increase in debt payments, debt obligations in retirement. So my advice is try to really get your debt under control. Pay back everything you can, destroy your credit cards if you find yourself unable to live within your means. Think about downsizing, think about moving to a state with lower tax rates. All those things are ways to try to stretch your dollar a little bit farther in retirement.
Olivia, we only get to spend 24 minutes together on this podcast, and in the time that we have left, I'm curious, given your years of academic research on this topic, what haven't we covered? What needs to be reemphasized from our discussion?
Well, I think the one of the areas I'm working on now is financial advice and how financial advisors can do a better job giving us what we need to make those decisions. There was an article I read the other day saying that there's a lot of financial advice online, social media, is full of influencers providing financial advice, but some of them are conflicted. Some of them are giving terrible advice. I would like to see a better way of evaluating financial advice where people are getting what they need throughout their lifetimes. We did a review of financial applications that provide advice a couple of years ago, and it was my conclusion that they were getting better in terms of helping you decide how much to save, where to save, how to allocate your portfolio, and so on. They were really falling down when it came to things like, when should I claim Social Security? How much should I annuitize? And then taking into account the family structure, if I have a defined benefit plan and my spouse has a defined contribution plan, how can I jointly optimize over those saving and payout decisions? So I think that the whole financial advice field has to really be improved and supported. Maybe the fintech and the large language models will help. I read recently about a company that is designing avatars to help you picture yourself in retirement if you follow this lifetime path versus another lifetime path. And I think that's brilliant. It really has the potential to help us picture our future selves. And that's exactly what we need in order to be able to look at the impact of our decisions on our future outcomes.
Yeah. And it strikes me that it's a tall order in some ways, in part because I look at retirement as complex, filled with contradictions, filled with complexity, filled with new laws, filled with new research. Sometimes I use the story that I once had a chance to listen to Professor Jeremy Siegel talk about stocks for the long run, and at the same time listen to Professor Zibodi say you should never have stocks for the long run. And just having those two contradictory points of view had my head spinning because I didn't know who to believe.
Well, that debate continues. I tend to be a conservative investor, and so I'm probably holding a lot less equity than others might recommend. But I also look at my downside risk, and at my stage in life, I ask myself, how much would I be willing to lose? And I'm not really willing to lose much of anything. If I don't earn a ton of money, okay, fine. So that's my philosophy.
So that's it for this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you better plan for or live in retirement. And don't forget, for the latest retirement news and expert analysis, check out yahoofinance.com.